Hi, folks. Welcome back. Today, we will start a new series of our advanced trading courses, which is targeting professional traders, and that is called the Q. Q is a series of advanced courses. Today, training course is of this series is about how to monitor market sentiment and conditions. Upon this completion of this trading course, you will learn how to monitor market sentiment and conditions. You will know what are the best trading hours in the day, and how they start. You will learn how to how the markets are correlated with each other. Okay, let's go for that. Okay, as usual, folks, please have a minute to read our disclaimer here, and by continuing this watching this video, you consent that this disclaimer. Okay. So the most important things is that when you as a trader wake up in the morning, and then you get prepared. Okay, what to watch, what to do, and how to start your trading day, and how to review your trading plan and strategy, and so on. So, but one of the aspect of all this trading plan and strategy for every day is what to watch of the market, because that is the most important. That's where is basically driving the price and driving the market. So the first thing that you need to watch is what are the best indices to watch it for. We know that the S&P 500 in United States, and Wall Street, Dow Jones, and Nasdaq. These are the very the whole world are looking watching these indices. Even when the market is not closed, they look at the futures, and also we look at the Asia Pacific Asia, and so Europe. In Europe, so we have a DAX 40, German 40, call it CAC 40. We have France in the stock markets exchange, and then we have FTSE 100 in the United Kingdom, and we have EU stock 50 that basically has the 50 biggest European companies, and all these indexes, and then we have the dollar indexes, and that which is very important to look at that. So there are a lot of them, but you need to look at that. So it's very important that you have a watch list for all these important indices. The things is that you have to look at that what are the timing, which of these indices have the control over the market. So when Europe is open, they have the control, and then when US is starting overlapping Europe market, and then taking our control, and then when US is closing, then Asia is taking control. That goes around for 5 days a week, and the other things that is very important is that what are the best trading hours. I think this is extremely important, because this is where basically it helps you to make a good decision, and then take the opportunities to in the market. Okay, so what are the best hours? For the best hour, we will in this course provide you a table. We call it Q table. This Q table will specifically tell you a specific time what is happening, how the supercomputers on the trading floor are acting, how the trader are acting, how they are set they are set to in different specific different times how they are reacting, and you can use that table and look at the market to verify that and to see that realize how the market is basically acting within that small that specified time interval. Okay, you look at that and you will see, okay, wow, this is really something is happening here, and then you will slowly adopt that to your strategy and know, okay, in this particular time I will not trade, I will wait until this time what will happen, and all this will be very useful. This table is going to give you a lot of information that you can use it in your trading plan and strategy. So the other things is that macro data is report are very important, which basically we have an economic calendar you can find everywhere on the most famous TVs like Bloomberg, CNBC, and all others. That there is a fixed economic calendars which basically tells you, okay, what are the macro data that will be released today. For example, Friday 1:30 UK time, there will be non-farm payrolls from American, which normally affects US, affect all the market, and this statistic is coming every Friday, every first Friday of every month. So this kind of report you have to have always in your mind to look at that when you start your day. You look at okay, what is the economic calendar that is telling me, and then the most of the economic calendar they have a very powerful filters. You can filter that in a way that, okay, it just bring you all the those macro data dates that is very specific and related, that has impact on your assets that you have traded or you are about to trade it. And then you look at that also this calendar for the earning reports. You need to be very careful when the earning seasons is starting, and then you have to be careful, okay, or for tomorrow, for example, at this 9 o'clock the Apple will release their earning report, or Google will do that, or Facebook is gonna do that, and then you need to plan such a way, okay, how you have to in your strategy. If you have an assets that there will be a earning report the next day or next hour with that, how you can or that day that you are starting your trading, how you can protect your investment, how can you plan so that if it's good news you take the advantages of that, if it's bad news how you will get out and minimize your risk and cut the losses. And this is very important that you have to do it. And the other important things is that you need always to watch the market pre and after and pre-market. So if for example Europe market is starting 9 o'clock 9 UK time, that means basically 8 UK time is started. That means basically you need to at least to be 1 hour or half an hour early to up and watch the pre-market and see how the pre-market is reacting, and that reaction will come into the initial hours of the market, which is the best time for trading, and then after that the market will slowly stable. Okay, so and then exactly when market is closing, we are going to go into the after market trading, and again there will be a lot of the heavy volume, that a lot of heavy orders that coming either for sell or for buy, and those are going to continue even after the market close, unless there is reports or earnings report that is coming after the closing hour. Okay. So the third one is that you need to stay tuned with news and events, because this market is driven by sentiment, by psychology. by trader psychology. It's very, very important that you are up to date with news and events, and there are news that can come during that day, and that or if you, that can affect your basket portfolio. Or for example, if there is let's say a meeting, for example, OPEC has a meeting that we know that okay, during the day they will have a press conference, or they will release what is called statement, and the bond market will react based on that statement. Or there is something ongoing in the American USA Senate and the Congress, and the Congress is the market is just watching the Congress to get some clue how to react. And these things are very, very important, because they can have a huge impact on the market, and you need to consider them seriously and put these as a one of the most important items in your trading plan and strategy. And the other one is basically the market correlation. Market correlation, this is very, very important. Why? Because all the market, they have they have something common, related. That they are related to each other via smart money. That is the smart money that is just going around from one market to the other market, and the whole market is based on the speculation and basically is a speculative market. So a market that is driven like a psychology, and also the market are looking at other indices, other market, how they are reacting, and what will happen. So sometimes you will see that okay, dollar is falling, and that is because of the dollars. The market is starting reacting opposite way, and then the interest or rate market suddenly had a movement, and that movement immediately will have if it goes up, that will have immediately a negative effect on the stock market. And this shows how correlated. So these you need to find all the correlations between all the market, like the bond and rate market, the stock market, forex market, the commodity market, and so crypto market, and identify the relation between these, and the correlation between these markets, and that is basically defined by coefficients from -1 to 1. I normally say that it's easier to say from -100 to 200, because you can then use, say, okay, these market are if for example if in the coefficient -1 to 1, then you say that okay, 0.2 to 22, that is the correlation, minus or plus. But it's very easier to say okay, this market and this market, for example, gold and dollars have a negatively what is called the correlation, and that correlation is 0.25, but it's very easy to say 25%. So I prefer that we use the term -100 to 100 instead of a normal coefficient that used in different equations for this purpose. Okay, that will make it easy for us to even discuss that. So the correlation basically has two items, two ways, either that is positively or negatively. Positive means that two markets, they are affecting positively if that market they positively on each other. So if there is good sentiment, and then on the other market, that good sentiment reflects in this market and affect this market, like all the major indices, they just follow each other, they just move each other. There are a specific timing that they go different directions, but as I said, this is depends on the correlation coefficients. So what is the correlation? But 90% of these market, they are correlated directly positively. That means they and they if for example S&P goes up, Europe follow that, or if there is something negative in Europe, and that is affecting the sentiment on the for the investors sentiments on S&P. So they are, this is called positive, positively correlated. Negatively correlated, or when they go opposite each other. For example, for example, the dollar and the gold. So they go opposite each other. So if for example gold goes up, and that basically make then the gold goes down. Why? Because the gold is the dollar is getting stronger against other pair of other currencies, and that makes the dollar, the gold, more expensive for them to buy it. But when dollar is falling, that make for all other currencies, that make the gold very cheap for other currencies, and then they start the buying gold. So this is negatively correlated. So this correlation is very important. Everything in this market is correlated with each other. You need to really study that and make sure that, okay, you understand the correlation. If you do not understand the correlation, suddenly you will see that you have make the technical analysis very perfect one, and you have look at the market structure, and you have everything so perfect, and suddenly you will see that, okay, that was actually that was not good the analysis. Why? Because you have not considered the correlations, because you have not considered the correlation that this correlation can cancel cancel your what is called your analysis, or invalidate your analysis. Why? Because there are other factors, factors that are affecting your these assets, that is out of the your chart, or your price history in the chart. So those will not be counted in your technical analysis when you are doing that on the chart. So it's very important that you really look at that and define for your asset your asset correlations with other things, how they are affecting that. At the end of this course, I will show you the correlation between Bitcoin with other market, and then you will be surprised. Okay, how you might never, very rare you have believed that there is any correlation. For example, between Bitcoin and crude oil. You might Brent crude or U.S. real estate, these things, if they were at all have any effect on bit. But this is very important that you guys really can identify the correlation, between the market and the your assets correlation. And then we have not only the market, and then within the market we have sectors, and those sectors are also correlated. You will see one sector is going up, immediately the other sector is falling. Why? Because they are negatively correlated with each other somehow, and or positively. Identifying all these correlations between the assets and also the market will help you a lot in your trading plan, and help you to make the correct decision for trading. Okay, but remember always this correlation that can change. Why? Because this market conditions and the sentiments can change any time. They depends on how there are a lot of other factors that will come and make changes to that correlation will be changed. So you need to always get yourself updated with these changes, and stay tuned with news and events in order to and look at these correlations that is still valid and that has not been changed. So it's not like this, when you find a correlation, you see that correlation is forever. No, that correlation, it could be for a specific time. That correlation, it could be because of special things that has happened, like a COVID-19. When COVID-19 came, the correlation between the stock market and dollar, it become negatively, while before that it was positively positive. So you need to look at that, okay, always, that to have that in mind, that the correlation that you have find it between the different items in the market and the markets, then those can be changed. The other things is that you need to look at the market structure. Look, maybe I personally divide. Uh, uh, I see technical analysis as a very, very personal things, that is related to your personal strategy, whether you are a day trader, a swing trader, or a position trader, whatever. So based on that, you basically make you choose the time frames for analysis. You make the things that is good for your trading strategy. That's why it's personal. So your trading strategy will be different from mine. All traders have different strategy. That means basically they will have different perceptions about technical analysis for the same thing that you do. But among all these, there is some very, very important thing that is common between all traders, and you need to focus on those, because those make you make you closer to the real world. That makes you closer to read the other traders' mind. Okay, and that is market structure. Because why? Because that market structures is not is something that is based on personal strategy, but it is something common that is being used by all traders and even supercomputers on the trading floor. This is very, very important. That is why, because it's a very common tool that is being used. So that will make really help you to read other traders' mind, and to see what they think, what they do, and how to identify the key areas and consider these key areas in your technical analysis. So the market structure is completely different from the technical analysis. Okay, we use the same tools for identifying the market structure as for technical analysis, which means basically you use the chart, you use the history of the data history, and you use indicators, different indicators, and so on. But you use them not in the purpose of identifying entry or exit point. Instead, you are doing that using those tools or indicators, or for understanding the market structure, because the market structure is something that is for every trader. It's not only for you, it's something that is specific to you. So that will make you to get closer to the reality, closer to the other traders' mindset, and so on and so on. So what is the market structure? Basically, market structure, we can very easily divide that on by three. It has three items, which is the trend. So a trend can be a horizontal trend, a trend, a diagonal, or a uptrend, a downtrend, or range, whatever. So that is something that everybody can see that. Okay, and then the other one is support. So that support, for example, it could be a 52 weeks low, or the 52 weeks low, or some other other like trend lines or moving averages and all these that being used. So those tells you actually this is there is a key level here for support, which is supporting the price. So that is something that everybody see that. Okay. And the other one is resistance. Exactly, for the resistance, exactly like support, there is a lot of tools that you can use. For example, you can look at the moving averages, you can look at the 52 weeks high, you can look at the trend lines, you look at the boundary of these trend channels, identify channels on the chart, and see how do these channels are, or whether they are uptrend, downtrend, range, all these you will consider them as either a resistance or a support, and that will give you the whole picture of the market. Okay, so if we summarize here what to watch, basically this is the 5 things that you need always to watch it, and you need to always have that before you do your day, starting your day of trading. Okay, before starting of the day, you need to have 3-4 minutes to review this and say, okay, the specific time, okay, I have a Q1 table, so Q table will be there, and I will look at that, and then macro data, do I have any macro data today that is coming that is affecting my portfolio, or earning reports, and so how the pre-market and after market are reacting before the market is starting. That will give you very, very crucial information. And the other one, you look for that, oh, there is any specific news and event that is coming during the day that will affect the market sentiment, the market condition, and so on and so on. And then you will see that, okay, today you have before identify the correlation between your asset, the asset in your portfolio with some other the market on the some other assets in the market, and then you look at that, whether over the night in Asia or USA, what has happened, does how much those will affect your asset, so that you can these will give you good information so that you can guard yourself, and that be on your watch in order to cut losses and or let it run for more profit, maximize your profit. And the most important thing here is the market structure. So market structure, as I said, that is different from the technical analysis. A technical analysis for entry and exit point, they are completely personal things. They is different from one is different from one trader to the other trader, but the market structure is not. The market structure is something common between all the traders. That's why it helps us to get one step closer to read the mindset of other traders, and also the market condition and the sentiment. Okay, so this is very important. Don't forget these five point. Okay, let's go. Now we are coming to the time specific timing. Okay, what are the best hours to trade? How you look at the if you just as a trader, you just go look at your chart and look at the price movement, and also that you get nowhere. You just get more tired, frustrated. It's especially if the market is going against you and you don't know what is happening, and then suddenly you will see at that specific time something happen, and then you don't know the next 10 minutes something that is normal that is happening, and next 10 minutes it will come back, and then what it will do, it will push you to make a crazy decisions, or make decision that you will regret it. But 5 minutes, 10 minutes, you will see that it goes back to the same condition that it was before. Why? Because you are not familiar with the how how this market is acting, how this market is moving, how this market is processing. If you know the process of the market, and you know all these specific times, how how the market is moving or acting within these specific times, that will help you a lot. That will stop you to make the wrong decision. That must stop you to let your feelings to control you, because okay, after 10 minutes this is normal, that is happening at that time, every day it happens, and 10 minutes later things will go back to normal. So what do you see that this is a golden information. This is a golden things that the factor that you can use in your trading plan and your decision. But look how it will help you to make the correct decision. So if I go here, so I go if you look at here, I have the important time for world investment market. British the time here set is British summertime, and so the time zone in London, that is GMT +1, and I have the Europe US crucial timing to watch, but you can extend that to the Asia and then come back again to the Europe, okay, so that you connect the whole world, that they are almost the same they process almost the same way as it's here for Europe and the US market. Okay, let's start what we have it here. So the Europe is UK time is starting 8 and 8, so between 8 o'clock to 5 minutes past 8. So the market is very choppy, often noisy. So you need to be staying away from doing anything within that time. And you have already looked at the pre-market, how the pre-market was acting. Okay, then 5 minutes past 8 to 25 minutes past 8, we will see an initial drive and solid move. You will see, okay, most of the time this initial drive and this solid mode is coming exactly on the same direction as it was in the pre-market, as you saw that in the pre-market when before the market was open, because that is coming from Asia, and that is coming from the future markets in USA, and also the future market for Europe, and they all combine to each other, and then that most of the time that goes exactly the same direction as that. So between 5 past 8 to 25 past 8, you will see the initial drive and solid mode that is exactly mirror of that what you saw that in the pre-market. Okay, then what happens that 25 minutes after to 40 minutes, you will see potential reverse. You will see that, okay, something is happening. Okay, the market is okay, had that initial drive, and now is pulling back. Is something is happening because those was a set of orders that came, and those orders were executed and finished, and then you will see, okay, the order book is now looking differently. It must look, for example, lighter, and there is potential there for a reversal of the move. Okay, and then 40 minutes to the 8:40 to 9, that means 40 minutes after the market started to 1 hour, that you will see the day's mini trend that give you an initial idea that what will be the trend of the day. So you will never go against that trend. You will not make yourself smart to say, okay, I will go short position against this trend because I knew it will fall. Why? Because I saw that it happens within this time. I saw that within this time I had a reverse, happen. I saw that I know it went back. So I think it will come back. It will fall again. But that is not the case, because in that specific time, that will give you the mini trend of the day. So you need to consider that, and then after that you wait and see to confirm that mini trend. What is that? So you will wait, you will not do anything at all, and you look at that from 9 to 9:16. So that is about 16 minutes after you get the confirmation, you see the mini trend, and then look at that. If you got that trend solid, and then it's time for you to make your move, make your move, and to make sure that you are moving on the same direction as the market, as your asset. Okay, so as the store, or the assets that you are intended to trade. And once that has happened, then every 10 minutes, so 10 minutes hourly boundary. So for every hours, you will look at that just 5 minutes before the hour is completing, and 5 minutes after that one. Always it happens in a moment that it happens in the market. So you can take that opportunity in that specific 10 minutes, which is 5 minutes on this side of the hour, and 5 minutes on the other side of boundary of the hour. That means when we are just about to complete the 60 minutes. So one is 55 minutes, that goes to 60 minutes, and then when 5 minutes are starting for the next hour. So within that 10 minutes, you will look at the market, how market is reacting, and within that specific time, you will see a huge, maybe a big spike, or a spike in the market, and it might make you scared, and then you make the decision, okay, based on what you see that, and then 10 minutes later you will see that it came back on the same point that it was the same condition that it was just before that. So every hour you would continue like this until you come when US market pre-market overlapping with Europe market, which basically is 1 hour before the US market is arcane. Once that happens, the volatility increase and macro data time window is open, which basically means at that time there is a lot of macro data is coming. The window is open, the time window is open for macro data. Is initial jobless report, is GDP reports that is coming 1:30 UK time. So just within that US pre-market, all the almost 90% of the macro data is coming within that time period, the time period of US pre-market. So that means basically within that time we have a lot of volatility in the market, and you can use that volatility in your benefit, and you will know, okay, I will wait until I come to that time, and then within that time I see the condition is okay. When I have my profit, then I will take the profit, or I will do this, whatever. So it depends on the situation or the condition of the market. So that is very extremely important. The reason that is this time, the 1:30 to 12 to 20 past 2 or 14:20 is because of two reasons. One is the window is the data, the macro data time window we have it is just within that time, and also the volatility that increased because the pre-market starts, and the market look at that, okay, how the investors in the US are thinking. Are they in the good mood or in the bad mood? Morning's bad mood or a good mood. Okay, so that's why this is very, very important. Okay, and then what will happen that after 20 past 2 or 14:20 to 14:30, that is just 10 minutes before before the US market is starting, which is basically the control goes back to the US from Europe, goes back to the control the Europe, and everywhere they will look at the US market, how that will behave, and then they will act based on what the major indices that is moving on the US market. So potential mute market before US opens, that is very open, clear that within this time period the market will not move. It will be it will be somehow muted, because they are just waiting to see okay, what will happen when the US market is opening. So once that is opening, that goes okay. The first 5 minutes, exactly like a Europe market open, it is noisy, choppy, noisy, and then we after that we will have the initial drive and solid move. That is exactly the same pattern here, the same pattern we have here. We will repeat that here, and but this one is gonna affect this market, the Euro market, because before the Euro market was controlling the market, but now the US is more controlling the market. Okay, so that meaning that movement until here, until here, so the possible here possible reversion trend wise is the same as here, but then when we come to 1550 to 4030, that will exactly increase volatility. That is exactly when the US market opened, US pre-market opened. Why? Because Europe is about to close, where that 40 minutes before Europe closing, the volatility increase a lot, and a trader and institution are positioning themselves for next day, for the end of the day, and so on. So you will see a lot of volatility, and you need to take that into consideration, and don't let yourself to be fooled by that volatility as if there is something very bad happening to market. The market is getting worried, and the market is getting nervous, and the market is doing not. No, that is normal. That is happening every single day. That is because the traders and institutions positioning themselves for the end of the day, and for the next coming day. So that will be very crucial time here, just exactly like the crucial time here for when pre-market started there. Okay, and then what happens that after the market closed, the Europe market closed here, 1630 Europe market is closing, and then from that to 1640 US take full control of the market. Before, the market was somehow shared between these two, because even as a human, investors in the US also look at DAX 40 and FTSE and how they are. If DAX 40 and FTSE are pulling down, and then in US wanted to go up, they will definitely have a weight on their decision. So that is why the market somehow is shared, but the more control is by US market. So now US market take full control within that time, and then here it will start. Here there is two possibility. One Europe market is closing, and then when US is taking control about 20 minutes, that control is being set up, and all this resetting all the supercomputer, whatever, on making decision and all this, and then there are two things after that happens until 5 past 5 or 17:05, and that is either the trend that was before the market was closed in Europe, that trend will have a lot more energy. It will have energy, whether that is going down or up, it will have more energy, or it will have a reverse. So either we carry on that trend just when Europe market closed, okay, and or we go reverse. That means basically, for example, US market wanted to go up, but Europe is caution that Europe is not going up, and the Europe somehow is stopping the US to move too much up, and the US investors are waiting to until Europe closed. Once the Europe closed and the control goes fully in the hand of the American market, US market, and then they will come into the market, and then they go exactly drive the market with power to the same direction that was being somehow hindered or stopped by Europe, and that power goes up and until we come to that time, okay. And then once we are in that specific time, okay, what will happen then? Every 10 minutes, exactly what we have here, every 10 minutes at the hourly boundary, you look at the 5 minutes before, 5 minutes after, and within that 10 minutes, you just look at that how the market is acting, just look at that how the market is moving. And then in that move, it could scare you, it could make you to make a decision, or it could make you to let your feelings to take control of you. But you should know that is just specific to that time, and then after that time the market will go to the condition just before that time the time period, okay. So that is very, very important. And then we go until we go to half an hour before the closing hours in US, and then again the same things as Europe closing. The volatility increase much increase much more, and that is because the traders and institutions are positioning themselves, either they close their positions or they are preparing themselves for next day. So you will see a lot of volatility in the half an hour before closing market close in United States. After the market closed, the US day after market, a strong signal for the next day and Asia market. Okay, that's why, because after market, if the market has been positive and then it carry on positive, that will send a lot of send a signal to Asia and also to Europe. If, for example, the market is falling, just have fallen, and then right after the market is started, after market is starting moving up because of some earning reports or some news or some stuff, and then that will send the positive sentiment to Asia and Europe. Even so, the market daily correlation is much lower than the Europe and the what is called the Asia. And the crypto normally has a movement around that hours, and also all these hours, of course, because there is a correlation between crypto market with other market. We call something that is, when it goes to the correlation, I forgot something. We have a daily correlation, which basically means, look, those companies that are listed on a FTSE 100, they are listed also in DAX 40 or a German 40, and also in, maybe in S&P 500. So if that one during the night, for example, let's say HSBC went up, that is the difference between the price in the HSBC, but the price that in Europe is about $5. So what is happening, that the next day when the market is opening, immediately the HSBC is gonna to have exactly adjust its price with the price that was the closing price in the United States, whether that was up or down. We call this the correction, the what is called the daily correction. So the daily correction between the market is very, very important. You look at that. Okay, normally the futures, the indices, they tell you these this correction. For example, the US has gone. For example, when Europe was open, it was up, and then after that, the US drops. The index S&P drops, and then when it drops, and the market for the Europe futures, it shows, the indices shows that okay, they are in red, and they have a correction. When they open next day, they have a correction with USA. So that is very important, crucial information that you know. Okay, tomorrow when DAX German 40 is opening, that has a negative correction of 40 or 100 points with US or with Asia. That means basically they are gonna to start from that point. So you can use that one in your strategy, how to position yourself. Okay, so that is very important information for your trading. Okay, if I just go here, I will go quick with the crypto correlations. As I said, for the coefficients between the -1 to 1, if we have the correlation is less than 0, that is a negative correlation. If we have above 0 to between 0 and 1, that is a positive correlation. So here I have these according to the data by 1ec. So bit has become more correlated with S&P 500 with time. Okay, so but bit has been correlated with all other market as well. So if we so here you have the year for each year, whether that is negative or negatively or positively, this correlation and so until 2020. So we don't have the data for 2001 21, maybe in 2022 we will have that, to see how much that has been changed. But as it is, so the current 22, the correlation between there was a positive correlation between S&P 500 and Bitcoin, which was 0.22. So as I said, if you say that here, it's much easier for it will be much easier for you if you say -100 plus 100, because you can immediately say that okay, there is a correlation of 22% here. Okay, let's consider this as -100 and +100 as a coefficients for our correlation. So here we have a 22% that is positive correlations, and then we have a 7% correlation with the US bonds market, and then we have a 34% correlation with gold. That was 2020, and then we have 17% correlation between Bitcoin and the US real estate. Okay, then we have 23%. We had 23% correlation between Bitcoin and oil. And so and the emerging market currency, it was the biggest one, which was 25%, and that is exactly I think this is still is in place, and it has a very strong correlations on the crypto market. So this is just for your information how these are identified. You don't need to go in the details, look for this data. It's very simple. You look at okay, how the world major indices are they related with each other, how they are affecting each other, how they creating positive or negative sentiment on the buzz in the market, or the conditions, okay, market condition and all this. So this is very important. This was just an example for you that nothing in this market is exists that is not correlated with something else. Why? Because there is some, they have a common blood, or they have a related blood bond, which is smart money, because it's smart money that is going from institution, from traders, from to crypto. They take the profit and then move that on to another market that give you the better profit, and so on and so on. So the whole market are correlated with each other. And also the one thing that is driving the market is the sentiment. Once the sentiment in the market, how the sentiment is created? The sentiment is created by this correlation between the markets. The markets are looking at each other, and then based on that, and they creating a sentiment, a sentiment. So if we have, for example, a bad sentiment, there is no way that bad sentiment on S&P 500 or Nasdaq or Wall Street, that will not have an impact on a European market, or a Asia market, or a crypto market. There is definitely such a things does not exist. Why? Because they are so correlated, because they have today. Nowadays, even a normal trader, not an institution, or not a professional trader, they can buy from USA, they can buy from Asia, they can buy from Europe market, whether it's CFDs, spread betting, whatever derivatives you are using, or share, you can trade. So that means basically, if there is a sentiment in one of these markets, that sentiment is reflecting in your portfolio. So that is exactly for all the trader, or all the banks, all the institutions, and so on. So there is nothing, absolutely nothing in this market that is not correlated with each other. Everything is correlated with each other, but you need to make sure that you identify this correlation, and this correlation will be either positive or negative. So once you have identified that when positive and negative, that will be in your favor. That will bring you a lot of benefit. Okay, so this is where you go look at this correlation. Correlation is very important for a trader. If you look at the market like a 360-degree circle, so if you are decided just go based on your technical analysis, which I said that is just your personal things, then basically what you do, you just look, you are not looking at the market with 360 degrees, but you are looking at the market with just 20 degrees, and that is very limited look. So you should broaden your look to 360. How you do that? Yes, you do that with the market structure. You do that with the correlation between the market. You do that with the correlation between the sectors within the market, and you do that with the news and events. You do that with the macro data. You do that with that timing, the Q table that I just provided to you. This is we call it Q table. Okay, just in case you don't know, these things you will not find on the YouTube. These are created created by my years experience in trading. Okay, there is a lot of other things like this. I am gonna make videos for you in this Q series. So the Q series will be a little advanced, but very useful, and that is Q series courses that will make you to look at the whole 360 degree of the circle of the market, not just to look at your chart and see that. A professional trader use the technical analysis, just put you maybe 10-15% of their time on the technical analysis, and they do that when they have decided to, okay, the market structures, structure, the market condition, the market sentiment has allowed them to enter a position. And then what they do, they will come and then open their chart and do the technical analysis for entry and exit point. That's it. But before that, they never look at that for the entry exit point. They will never look at the exit, the entry, open a trade without finding out these correlations. Look at the events, look at the market structure, look at the market condition. When we say market condition, that goes all back to all these points. When we go market condition and sentiment, this is what is creating the market sentiment and market conditions. And once you have this will give you a sight of 360 degree, that you see everything in the market, and then suddenly you will see, that any decision that you the probability that you win or make a correct decision is very, very high. But if you just go based on technical analysis, or Magdi said this, moving everything, this I will enter here, I want to get, that is suicide. That is completely suicide. That's why 80-90% of day traders or non-professional traders, they fail. Why they fail? Because this is the way that they look at that. They believe so much in their chart and their technical analysis, and they believe that's it. If I learn about the candles, sticks, and moving averages, and all these different strategies, that is enough for me to do that. No, that is not. That is not enough. Okay, that is a very, very, very small set of a bigger set. Okay, so that is a subset. It's a small subset of a big set of criteria or factors that you need to take into consideration, and all of them are summarized here. All of them are summarized here. Believe me, if you do these 5 points, then you will have 360 degree look at the market. There is nothing in the market that you have missed. There is absolutely nothing in the market that you have not looked at that before you go trading. Once you have done these 5 points, then you go use technical analysis, your chart for entry and exit, but not before you do these 5 points. So these 5 points are extremely important. I hope I could get you the point here, how important they are. Okay, folks, thank you very much for listening, and I hope you had some useful information here for that can help your trading. Again, please don't forget to that we are not giving any advices here. We are just trying to share our experiences with you, and we are hoping that those experiences can give you some clues, some good information that you have not find that on other places on YouTube. Okay, I wish you good luck. Okay, have fun.